Test, 1, 2, 3. Test, 1, 2, 3. What's going on, guys? It's Ricky with Talk About Solutions. So today, June 21st, looks like Jerome Powell is just a little bit late, but he will be speaking in front of Congress. So just making sure that you guys are all aware of that. So it should be any moment now that he should be jumping on, as according to this, right? Should resume shortly. There it goes. Let me sell 1,500. Big push today on SQQ, 3.43% so far. About to test $20 a share. All right. Okay. All right, nice little pullback here. See if we can retrace back down. Once he begins to speak, we will. I'll put the microphone closer so you guys can hear the screen, but there's nothing going on as of right now. Okay, so that's why you guys can't hear anything. So if it's not too much to ask, hopefully we could earn your thumbs up on this video. I appreciate you guys dropping a like on yesterday's video and request to hosting this live stream. Again, I'd love to host more of these for you guys. I know that Jerome Powell speaks tomorrow live in front of Congress as well. We'll see how this one goes, but if you guys enjoy this live stream, then again, just make sure you drop a thumbs up, subscribe to the channel if you want to partake in that live chat. It is free to subscribe to the YouTube channel. And if you have any questions, especially as I do trade live every morning, I just wrapped up my quick little live session with the LPP team. And just so you could see where I'm at for the day on SQQQ, I walked away with a little bit over $2,100 on this nice little rip up. I have a very simple way of trading. It's not very fancy. I either go long or I go short depending on market direction, and I do it every day. So yeah, if you want to see my good days, my bad days, if you want to see kind of like my thought process behind every trade, second link in the description down below. It's a one-time payment, lifetime access, and we're running our biggest sell right now, and it's linked down below. So it sounds like it's about to start right now. We are still waiting for Jerome Powell to speak right now. All right. Thanks for the Father's Day LPP pricing, of course. 175 off. You can't go wrong with that.
Committee will come to order.
Here it goes.
Even
And
the photography crew come to order.
just a heads up, it is sometimes very hard to watch for a long period of time. It gets very dull and very boring. Just a heads up on that, okay?
Titled the Federal Reserve Semi-Annual Monetary Policy Report. Not the most inventive title, but traditional. We call Humphrey Hawkins. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I will note at the outset this hearing has a hard stop at 1 p.m., which we will strictly observe. The chair would further announce to committee members that the chair's intention is in the second week we return in July, we'll have a markup, and that markup will include 2 important bills. One is giving digital assets a market structure and federal regulatory remit. And the second is a federal stablecoin regime. It is the intention of the chair to have that as 2 pieces of our committee markup in the second week we return in July. I now recognize myself for 4 minutes to give an opening statement. Thank you, Chairman Powell, for joining us today. Inflation remains broad-based and persistent, 2 troubling trends the Fed expects will continue. As you said last week, the process of getting inflation back to 2% is a long way to go. So even though the Federal Open Market Committee did not recommend a rate increase at last week's meeting, it's fair to say that the Fed will continue to make additional increases in the months ahead. We'd like to hear your thinking on those matters. As the FOMC again pointed out last week, the labor market still appears tight, with Fed policymakers projecting a rise in an unemployment rate to a still low 4.1% at the end of the year. Despite pressure from the left, the Federal Reserve must remain committed to eliminating this stealth tax on American workers and families, and I urge you to continue that resolve. A few weeks ago, Congress took the first step toward getting our fiscal house in order through the Fiscal Responsibility Act. Republicans will continue fighting for sensible spending reductions to combat inflation. This stands in stark contrast to Democrats' spending spree that poured nearly $2 trillion into a supply-constrained economy that was already flush with trillions of savings provided by earlier bipartisan COVID rescue efforts. And after keeping interest rates too low for too long, the Fed was slow to address the problem. In a stunning about-face, the Fed then raised interest rates by 5 percentage points in a little over a year, the fastest spike in modern history. This approach introduced accelerated interest rate risk for which companies, workers, and families across the country were not prepared. The bank runs we saw earlier this year are an example of the consequences. Now we're told these runs represent a systemic threat to the stability of our financial system. Add in the commercial real estate exposure facing financial institutions, and it becomes very easy to understand the mounting anxiety consumers and job creators share. And I share their anxiety as well. The rapid rise in interest rates, coupled with knock-on effects of the bank failures, have led to signs of a credit crunch across the economy. This would have a damaging impact to consumers and job creators alike. To top it off, Vice Chair for Supervision Michael Barr is undergoing a so-called holistic review of capital requirements. And something interesting that he mentioned in the press even yesterday is a new approach to stress tests that I can't quite understand. If reports are accurate, he's pursuing a massive increase in capital standards for medium and large.
We're testing same resistance for SQQ right at $20 a share, just a heads up.
And starving families and small businesses the capital they need. Financial markets will also bear this strain as they will be forced to absorb nearly $1 trillion in new treasuries. This has led many to believe the Fed may be called on to help, perhaps through its repo or other facilities. Clearly, our economy is in a precarious position, from inflation to a potential credit crunch to substantial balance sheet risks for financial institutions. There is a great deal of uncertainty on the horizon. Uncertainty from the Fed supervision and regulation is the last thing the well-capitalized banking system needs now. Following numerous supervisory failures and a new vice chair for supervision at the Federal Reserve injecting politics into policy, it's become clear that Congress may need to again examine separating supervision and regulation out of the Fed and gaining greater oversight and control by Congress in the elected branches. With that, Mr. Chair, thank you for being here today. And the chair now recognizes the ranking member of the full committee, the gentleman from California, for 4 minutes for an opening statement.
Thank you, Chairman McHenry.
Oh, no.
Chairman Powell, welcome back. First, I'd like to start by acknowledging that the Federal Reserve made the right decision to pause interest rate hikes. As you know, since last November, I've cautioned against any approach to monetary policy that ignores the Fed's maximum employment mandate and results in a recession with millions of people losing their homes and jobs. While we have had strong job growth thus far, experts contend that this trend will not persist with more rate hikes, especially in light of new challenges. For example, the recent bank failures have resulted in the banking industry further restricting credit, making it even more important for the Fed to move with caution. The progress that we have made in reducing inflation is borne out in the latest consumer price index data. In fact, it's been 10 months, since the passage of the Inflation Reduction Act, and inflation has successfully been cut in half. Every single Republican member of Congress voted against the bill and chose to cozy up to the wealthy tax cheats instead of working with Democrats to bring down costs for middle-class families. However, the only way we will fully combat inflation is to address the primary driver of inflation, soaring housing costs. Congress must invest more in fair and affordable housing. Under President Biden, unemployment is also at a historic low and job growth is on the rise. So far, there's been 29 straight months of strong job growth. In fact, a record 13 million jobs have been created since President Biden took office. Democrats are working to build on this progress and grow the middle class so that everyone can share in this economic growth. Republicans, however, just can't seem to get their house in order on the heels of almost blowing up our economy by forcing a national default. They are now picking a fight over a tiny fee of less than 1% of total housing costs, ignoring the costs home buyers are paying with 7% interest rates, appraisal fees, and title insurance. Instead, they're fighting about gas stoves. In fact, just a week ago, Republican disarray got so bad that it halted business on the House floor for the first time in 20 years. Lastly, as we continue to monitor the banking system following the recent bank failures, the Fed must act to correct the supervisory and regulatory failures identified by our committee's oversight. Committee Democrats recently introduced 11 bills, including 3 of my own, to strengthen the safety and soundness of our banking system and hold executives accountable for their misdeeds. The Senate Banking Committee is holding a markup this morning on a bipartisan bill on bank executive accountability. So I urge Chair McHenry to join us in advancing sensible reforms to strengthen our nation's banking system. With that, I yield back.
Generally yields back. I now recognize the Mr. Barr, Chairman of the Subcommittee on Financial Institutions and Monetary Policy, for 1 minute.
We expect proposals from the Fed's Vice Chairman for Supervision that could increase capital for financial institutions as much as 20%. Our already well-capitalized banks withstood the COVID shock and severe Fed stress tests as the economy is facing headwinds from the Fed's own rapid rate hikes. Now is not the time to be engineering massive new regulatory changes or hindering regional banks, which have already been under stress. New onerous one-size-fits-all regulation by the Fed needs proper vetting and transparency. I would ask you today to commit to providing us with analysis done so far by the Fed on the Vice Chair's new proposals. I also respectfully ask that the Chairman revisit Section 1107A1 of the Dodd-Frank Act to observe that the Vice Chairman for Supervision is authorized only to develop recommendations for the board and oversee supervision and regulation. The law does not give the Vice Chair special abilities to unilaterally write his own preferred regulations. It does not say that the Vice Chair should unilaterally write public-facing book reports on bank failures or results of climate scenario experiments. Consensus is paramount.
Gentleman's time is expired. We'll now recognize the Subcommittee Chairman, Financial Institutions and Monetary Policy, Mr. Foster, for 1 minute.
Thank you, Chair McHenry, and to Mr. Powell for being here today. In the wake of what seem to be endless novel problems and disruption, I believe the Fed and Congress have done a reasonable job given the cards that we've been dealt.
Mr. Foster has a golden voice, does he not?
Anticipated recession from the endgame of COVID disruptions, if it occurs at all, will continue to be more of a soft landing than a disaster for our economy. While there is certainly more work to be done, but in the immediate term, we can reflect with satisfaction on the historically low unemployment, 11 straight months of slowing inflation since the passage of the Inflation Reduction Act. However, I recognize that the necessary monetary policies put forth to combat inflation have not been without stress, including on the fraction of our banks that chose to ignore the Fed's clear forward guidance on that interest rate hikes were in the pipeline. We on this committee remain committed to alleviating the financial stress for everyday Americans to pay rent and get food on the table. I look forward to discussing how recent policies have performed and what else we should do going forward to ensure a strong economic rebound. Thank you, and I yield back.
Today, we welcome the testimony of the Honorable Jerome H. Powell, Chair of the Board of Governors of the Federal Reserve System. Chair Powell, we thank you for your time and being here. We'll recognize you for 5 minutes to give an oral presentation of your written testimony. Without objection, your written testimony will be made a part of the record. Chairman Powell, you're recognized.
Thank you, Chairman McHenry, Ranking Member Waters, and other members of the committee. I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report.
Chairman Powell, if you'll pull the mic closer.
Tell him to speak up.
Thanks.
We at the Fed remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve, and without it, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 5 months of the year, job gains averaged a robust 314,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in April, total personal consumption expenditures prices rose 4.4%. Excluding the volatile food and energy categories, core PCE prices rose 4.7%. In May, the 12-month change in the CPI came in at 4.0%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. With inflation running well above our longer-run goal of 2% and with labor market conditions remaining tight, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5 percentage points since early last year and have continued to reduce our securities holdings at a brisk pace. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. And the extent of these effects remains uncertain. In light of how far we have come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the FOMC decided last week to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. Nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at last week's meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, we will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, inflation, and inflation, economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability, again, is essential to set the stage for achieving maximum employment and stable prices over the longer run. Before concluding, let me briefly address the condition of the banking sector. The U.S. banking system is sound and resilient, as detailed in the box on financial stability in the Monetary Policy Report. The Fed, together with the Treasury and the FDIC, took decisive action in March to protect the U.S. economy and to strengthen public confidence in our banking system. The recent bank failures, including that of Silicon Valley Bank, and the resulting bank stress have highlighted the importance of ensuring that we have the appropriate rules and supervisory practices for banks of this size. We are committed to addressing these vulnerabilities to make for a stronger and more resilient banking system. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Chairman.
All right.
I now recognize myself for 5 minutes. Chairman Powell, as I laid out in my opening statement, inflation continues to be broad-based and persistent, both of which are concerning. Last week, the Federal Open Markets Committee decided to pause rate increases. And at the same time, the committee alluded that it would raise rates more later in the year. And so how should the FOMC's posture at the June meeting be interpreted? Will the committee continue to raise rates later this year? What's the thinking of this? What are we to understand?
Thank you, Mr. Chairman. So you're right, of course. We did decide to maintain the federal funds rate at its current rate at this meeting. At the same time, participants submitted personal forecasts suggesting that almost all of them thought there would be additional hikes. And I just want to say those two things are entirely consistent. The point being that the level to which we raise rates is actually a separate question of the speed with which we move. Earlier in the process, speed was very important. It's not very important now. The sense of the summary of economic projections and the decision really is just that, given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace. That's really it. You know, we were at 75 basis points for several meetings. Then we were at 50 basis points, then 50 basis points, 25 basis points at 3 consecutive meetings, and now we're moderating that pace, much as you might do if you were to be driving 75 miles an hour on the highway, then 50 miles an hour on a local highway, and then as you get closer to your destination, as you try to find that destination, you slow down even further.
JP with the analogy.
So it is more data is necessary for the Fed to make these decisions. And that's one interpretation, but thank you for a broader view there. I also want a broader view on this question of the vice chair for supervision is performing his own personal holistic review of the Fed's regulatory framework for bank capital and liquidity. In an interview yesterday, he discussed some version of a new type of stress test even, striking complete confusion in his description of it. And at the same time, we have testimony from you, even from the vice chair of supervision, saying that we have a sound banking system that is well capitalized. You will sit in judgment of this proposal that the vice chair for supervision will bring to the full board on this holistic review of capital. There are a lot of discussions about the amounts of capital he's talking about. The concern that this is pro-cyclical at a time where our economy with higher rates is you're measuring what's happening in the broader economy, and at the same time we're going to have a major piece of capital required by financial institutions, which will further restrict lending. So how can you tell us to think about that, given your seat on the Open Markets Committee and as a Fed governor? How would you interpret that?
So I guess I would say you're right. There are a significant number of proposals that are kind of in the works. They haven't been finalized, let alone brought to the board yet. And so I can't really get into specific details today.
Well, we like your thinking, Chairman Powell.
I will,
That's what we like.
what I can share is, principles and how I will think about this. Regulatory proposals go to the board. Every person on the board, that's 6 governors now, has an obligation to evaluate and vote on those. And I'm one of those people. I also chair the board. So a couple things I would point out. Just first that, I think regulation should be transparent and consistent and not too volatile, and particularly as it relates to capital requirements. I do note the central importance of capital. We want banks to be resilient to shocks. We want them to be able to lend in good and bad times. We want, in particular, the GSIBs, the 8 largest banks, to have high levels, very high levels of capital and liquidity. Indeed, we spent years raising those levels over a long period of time. And I think there's broad agreement, as you point out, that capital is strong. And the question there would be what sorts of increases will be justified. That's what we'll be looking at. The other thing is to point out the trade-off between higher capital. The benefit of it, of course, is to have stronger banks that can lend and maybe survive more kinds of crisis environments. But there are costs as well. And I think it's going to be, as always, a question of weighing and balancing those costs. And that's what I'll be thinking about. The last thing I'll say about that is just we benefit from having banks of all different shapes and sizes in our system. And we want to be careful not to regulate the smaller banks to the point where really their business models are challenged for all but the largest banks.
Well, this committee would expect to see a quantitative analysis of whatever the capital charge is going to be. We would expect that from the Fed, as we do from other regulators. With that, we'll now recognize the ranking member of the full committee, Ms. Waters, for 5 minutes.
Thank you very much.
Waters.
Chair Powell, at this committee's last hearing on digital assets, my Republican colleagues proposed a stablecoin bill that would create 58 different licenses with federal regulatory approval over only 2 of the licenses. The remaining 56 licenses can be issued by each state, territory, and DC with little or no federal oversight, regulation, and enforcement. This proposal takes state preemption into a whole new level. It effectively allows every state to preempt another state. DC-based coins, for example, would be sold to individuals nationwide, and New York or North Carolina regulators could do nothing to protect their own residents, while even the Fed would be severely hamstrung in providing any oversight. I've argued that we should allow states to be part of this process, but we must have a strong, enforceable federal floor with a role for the Federal Reserve to approve and provide oversight of payment stablecoins issued by non-banks in order to ensure that consumers are protected. Such a framework is similar to our dual banking system, and it would ensure that non-banks and banks are treated the same. We should also bear in mind that payment stablecoins are a new form of currency intended to allow individuals to pay for things with them. As such, do you agree that it is important for the Fed, as our central bank, to have a chance to approve or decline any state licensed non-bank entity before it starts issuing payment stablecoins nationwide?
Well, first of all, let me say we appreciate that we've been able to offer our views on these things to your staff and also the majority staff, and we appreciate the consideration that's given to our views. We do see payment stablecoins as a form of money, and in all advanced economies, the ultimate source of credibility in money is the central bank, and we believe that it would be appropriate to have quite a robust federal role in what happens in stablecoins going forward, and that leaving us with a weak role in allowing a lot of private money creation at the state level would be a mistake. But nonetheless, again, I do appreciate that we've been able to be heard and share our views with the committee.
Well, thank you so very much. I am appreciative for that clear answer. The next question that I have for you is a bit unusual. But one of the reasons we push diversity is because those things that have not been discussed, issues of people of color, etc., have not been dealt with. I'm going to throw you something that you would not expect. Earlier this week, our nation celebrated Juneteenth, which Congress recognized as a national holiday for the first time since 2021. The holiday celebrates the day enslaved African Americans in Texas heard that they were free 2.5 years after the Emancipation Proclamation was issued. To this day, Black Americans grapple with enduring racial economic inequality that has its roots in slavery, as evidenced by the Black-white gap in net worth and home ownership rates. My bill, the Federal Reserve Racial and Economic Equity Act, would require the Federal Reserve to carry out its duties in a manner that supports the elimination of racial and ethnic disparities in employment, income, wealth, and access to affordable credit. Now, the Fed has a number of duties to pursue maximum employment in the monetary policy, to supervise banks for compliance with our fair lending laws, and to ensure the Community Reinvestment Act is administered in a way that puts an end to discriminatory redlining practices by banks. Do you agree with me? And Atlanta, Federal Reserve President Raphael Bostic, among others, that the Fed has a role to play in addressing racial economic inequality as it carries out its work until Congress passes this bill. What steps will the Fed can you take to address racial and economic inequality?
So we do consider inequality in the economy as part of our thinking about decisions, but ultimately, and those are certainly highly valuable social goals to pursue. I would say our ability to take part in addressing those issues is fairly limited. We have one federal interest rate that we set. We do try to keep in mind, as you know, not just the aggregate national level of unemployment or employment, but also that for different ethnic groups. So we take that into account, but I would think, and I think that's just part of making sure that we feel like we have all Americans in the room with us when we're making decisions on monetary policy. I will say, though, I think other agencies are better suited to address these deep issues.
Thank you. We must have this continued discussion on racial equality. I yield back.
The lady yields back. We'll now go to the Vice Chair, Mr. Hill of Arkansas, for 5 minutes.
I thank the chairman of the committee, and Chairman Powell, great to have you back before the committee. And this morning, you've reiterated, and certainly Vice Chair Barr has reiterated a number of times, that the banking industry here in the United States is well capitalized. And in fact, capital levels have remained robust despite COVID-19, with a 20% plus unemployment rate increase and a 9% output gap. They've remained stable through government shutdowns. They've remained stable through severe stress testing. And maybe more importantly, just in the last few months, since the first week of March, you've seen strong capital come into play as we've grappled with the reality of a 40-year increase in short-term interest rates and that impact on banks. But as the chairman said, Michael Barr continues to say he wants to increase capital requirements on certain financial institutions. And in March, you testified that you said, I will do everything I can possibly do to bring people together, meaning on the Board of Governors, in consensus and have a capital framework that could be broadly supported. So to what extent have you and the other governors been involved in this so-called holistic review by Vice Chair Barr? Has he briefed the other members of the Board of Governors thus far?
Yes, and we've all been briefed by staff, really, on the proposals, but as I mentioned, they're still somewhat in motion. But yes, we've been briefed.
So you would say those proposals are still under consideration and that there's no final decision that's been taken by the board?
No, well, no, once the proposals really do settle down and are written up, they'll come to the board for a full discussion and a vote.
Has the Fed board reconstituted now the Committee on Supervision and Regulation? The membership of it?
Oh,
who's on that committee now?
So that committee is chaired by Vice Chair Barr, and it also includes Governor Jefferson, and it includes Governor Bowman.
When you look at capital in the U.S., and I look at the globally significant banks here versus other places in the world, would you say that the U.S. banks, the U.S. G-SIBs, are better capitalized than their global peers in Europe or in Asia?
So we're certainly at or near the top of the league table. I think there are a couple other jurisdictions that also
Watch for the
have
break above for
relatively similar
SQQQ.
levels of
NASDAQ
capital.
about to make new
Yes, they're
lows.
at the top of the league table.
I looked at it this morning, and US GSIBs have 11.3% capital without any kind of modification compared to their European competitors at only 9.9%. So would you say that we're better capitalized than the European banks, the European GSIBs?
I hate to call out the other jurisdictions, but I would say our banks are very strongly capitalized and also competing quite successfully globally outside the United States.
Yeah, I agree, and I think we've strengthened capital, we've strengthened our supervision, notwithstanding the problems that we saw this spring, which we've talked about ad nauseum here. But that capital standard does make American banks, I think, stand out. And wouldn't Basel, the so-called Basel III holistic reforms, wouldn't it be better if the European banks did a holistic review and actually got their capital up to American standards?
So I think they are bound by the same. No one's bound by these, but they have agreed to follow the same standards, and I think they're going through the same process we're going through.
Same topic, are the FDIC supervisory process and the OCC supervisors, are they involved and engaged with Vice Chair Barr in looking at this, quote, holistic review of capital adequacy?
I think,
in other words, are they providing their input to the Vice Chair for supervision in their own views on this topic?
on the regulatory proposals that are relevant to them, yes. I think on the capital proposals, yes, I believe so.
And you made a comment a minute ago, I think, to Chairman McHenry's questions about that you'd like to see rules and supervisory rules consistent over time. And I think that's frustrating here. We see change in administration. Sometimes we see change in rules, which is, I think, frustrating to the private sector and to market participants. I note that the Biden administration says that the Financial Stability Oversight Board should now base their decisions on size as opposed to activities. And for several years now, we've had an activities designation and a cost-benefit analysis. Do you think the activities designation gives supervisors more discretion at FSOC to select who should be deemed under their supervision?
Well, I actually think that one
in other words, is size alone, should we be looking only at size, or should we look at cost-benefit analysis and activities? And my time's expired. If you'd answer in writing, okay, I would appreciate it. I think this is an important issue. I yield back, Mr. Chairman.
Anyone else just annoyed of these questions? You guys let me know. And yeah, I do appreciate you guys tuning on into this live show. I know it can get kind of boring. We're probably going to close it out pretty soon anyways. But if it's not too much to ask, again, feel free to drop a thumbs up and subscribe to the channel if you guys haven't done so already. For my overall position, SQQQ as of right now, I closed it out. We're just not showing much signs of progress. So I'm up 2.1K on the day. But remember, my biggest focus is progress. And if we're not seeing progress on the upside, then again, this thing just consolidating, it's not making me any more money, right? And when direction is unclear, then again, when in doubt, right, cash out. So that's my idea behind that.
So our statutory goals are price stability and maximum employment, and we are dedicated to using our tools to achieving those. In the case of employment, we still have historically low unemployment rates and high employment rates now, high participation, a very strong labor market. We're very far from our inflation target of 2%, and we're very focused on getting back to 2%.
And how does the FOMC takes into consideration the impact of rising interest rates on LMI communities and small businesses when determining monetary policies?
So we only have one interest rate to raise or lower. It's not true, but mainly one main interest rate to raise or lower, and it applies to everyone. But I would say that inflation hits LMI communities and people generally at the lower end of the income spectrum much harder than people in the middle or the high end, because high inflation can get you into trouble right away if you're living on a fixed income just to cover the basic necessities. So it is for the benefit of those people that we must get inflation under control. It's for the benefit of all Americans, but particularly for those people. And we keep that in mind as we are strongly committed to getting inflation back down to 2% over time.
Well, and they are the same people that are having a hard time accessing loans. The same with small businesses. Chair Powell, Vice Chair Barr's report on the Fed's review of Silicon Valley Bank states that while there was regulatory tailoring conducted in response to S2155, there was also, and this is the part that really concerns me, a cultural shift at the Fed under the direction of the previous Vice Chair for Supervision, Randy Gross. According to the report, this shift included pressure to reduce burdens on firms, meet a higher burden of proof for a supervisory conclusion, and a need to accumulate more evidence than in the past. As chair during that period, were you aware of this cultural shift and the impact it was creating?
So I think we learned from the Silicon Valley failure and the others that there is going to be a need for stronger supervision and also regulation for banks of that size. And I'm committed to learning the right lessons from this exercise and to forthrightly implementing
But
changes.
were you aware of the cultural shift?
So I can't really characterize it that way. Certainly, I was aware that we were trying to avoid excessive regulatory burden. That
So
is
do you
always in our
disagree
burden.
with Chair Barr's report? in
Watch for
that
the breakout.
respect?
I'm sure that the people who wrote the report were accurately reporting what they heard from back in.
How often were you meeting with Vice Chair Pearls?
I reasonably frequently, we sat quite near each other.
And never discussed the cultural shift?
I didn't say that, but I don't remember it. The way you're describing it is not what I recall. I recall Vice Chair Quarles talking about things like focusing on the really important issues and not getting diverted into other.
So the way it was described by Vice Chair Barr is not what you recall?
Well,
So
I
what
had no part
steps?
in. I said I had no part in preparing the report. I'm confident that the staff who worked on the report reported accurately what they heard. I'm sure that that's right.
So what steps?
Yeah, I'm over this. I don't know if you guys are, but I'm just going to be going. It doesn't look like they're affecting the market as of right now too much. If you guys want to continue to hear it, I'm sure other people on YouTube are streaming it. It's just watching not watching paint dry because you just have to listen to them. Jerome Powell, I feel like he is a very sharp guy, especially for his age. I know a lot of you guys might not like him, but I think that for how old he is and what he has been doing, he's doing what he can, right? Within his means of being the head of the Federal Reserve. When it comes down to these older people that are part of Congress, it is so challenging. It's like, nails on a chalkboard to listen to the questions and the demands that they ask for Jerome Powell when obviously he can't even do half of what it is that they're asking. So overall, again, SQQ as of right now, indicating signs of an uptrend. NASDAQ pulling on back. If you're part of my LPP team, you know exactly what we were trading this morning. We're going into SQQ as the NASDAQ market was selling off. We talked about this yesterday. We were waiting for direction to be more clear. We literally said this in yesterday's video. Hey, heads up, Jerome Powell speaks tomorrow. We're at the moving average. We're at the EMA. If we break below the EMA, we can be working towards the moving average, just like we have in the past before. That's exactly what it looks like we're doing as of right now. Just like we could have found a support here and then began to indicate signs of an uptrend. But we waited for direction to be more clear. I waited for confirmation on SQQQ. And again, once we got that confirmation, I jumped into it. My trades were not perfect by any means. As you can see, SQQ is up 3.7% on the day, and I'm only up 2.1K. So I'll keep you guys up to date if I end up taking on any more trades. And I'll keep you guys up to date under the trade ideas section if you're part of LPP. Again, remember, I do trade live every single morning. You don't have to join if you don't feel like you are ready or if you don't find it of value. But again, if you want to be able to watch me trade live every single day, that's going to be that second link in the description down below. It's a one-time payment, lifetime access. And yes, you will be able to get access to being able to watch me trade live every single day. I really do appreciate you guys' time. Like always, let's make sure that we end the year